Level 1. $0 to $500 per month. $500. That is your monthly income. Not your rent, not your savings, your income. The entire amount that moves into your account every 30 days. Before the phone bill, before the groceries, before the $47 that disappears and you are never quite sure where it went. You are not here because of bad decisions. You are here because $500 a month is what the economy assigned to your hour. You cannot open a standard bank account without a minimum deposit. The institutions that will take you the check cashing counters, the prepaid cards charge between 1.5% and 3% per transaction to access your own money. On $400 a month, 3% is $12. $12 is 2 meals. The fee is not accidental. It is a product built for the part of the market that has no alternative. You apply for a credit card. The application is declined in 11 seconds. The algorithm does not know your name. It knows your income signal, and your income signal says, high risk, no return. Banks collected $15.5 billion in overdraft and account fees in a single year. The majority came from the accounts that could least afford to pay them. The math is almost elegant in how precisely it punishes the wrong person. If you had money, you would not be in this position. But because you do not have money, you now have less of it. Renting an apartment requires proof of income 3 times the monthly rent. On $500 a month, you qualify for rooms in buildings where the landlord does not ask for proof of anything and charges $950 for the privilege. You pay more per square foot than someone earning 10 times what you earn. The informal market charges a risk premium. The formal market charges the same thing through different paperwork. The first rule, at this level, money is not a tool. Money is the air. Either you have enough or you are already suffocating, and you cannot always tell which one it is. Level 2, $500 to $2,000 per month. A direct deposit appears. It is enough to open a basic checking account at a real institution. The account is free as long as you maintain a $500 average daily balance. Most months you cannot. The $12 monthly maintenance fee is withdrawn automatically from an account that cannot absorb a $12 withdrawal. You are earning between $6,000 and $24,000 a year. At the lower end of this range, you are below the federal poverty threshold for a single adult. Specific programs exist: Medicaid, food assistance, utility subsidies. Accessing them requires documentation, appointments scheduled during business hours, and wait times that assume you can take time off work. Many people at this level cannot take time off work. A secured credit card becomes available. You deposit $300 as collateral against a $300 limit. You are borrowing your own money and paying 27.99% annually for the transaction. This is how credit history is built when you are starting from the bottom. It is legal, it is standard, it is the mechanism functioning exactly as designed. Your payroll tax is 7.65% on every dollar earned, starting from the first dollar. There is no minimum. The person earning $1,200 a month pays the same percentage on every dollar as the person earning $120,000 a month. The rate is identical. The impact is not. You move $200 to savings. 3 days later, you move it back. You do not tell anyone. There is nothing to tell. The second rule: the system is not hostile at this level. It is indifferent. And indifference, compounded over years, costs more than hostility ever could. Level 3, $2,000 to $5,000 per month. The monthly maintenance fee disappears. Your direct deposit qualifies for a waiver. The institution that was charging you $12 a month for the privilege of holding your money has decided to hold it for free because the pattern of your deposits makes you worth keeping. Credit card offers begin arriving in envelopes with your name printed on them. Real cards, with limits between $2,000 and $6,000. At interest rates between 19.99% and 26.99%. The same bank that declined you at $500 a month is now competing for your spending. Nothing changed except your income signal. The algorithm responded accordingly. At $3,500 a month, you qualify for a car loan. The rate offered is between 7.9% and 10.4% depending on your credit history. On an $18,000 vehicle over 60 months at 9%, you pay $4,224 in interest. The person earning $12,000 a month buying the same car gets offered 4.2%. They pay $1,920. Same bank, same car. The price of money is lower when you need it less. This is not irony. This is the pricing model. You start an index fund with $500. The market drops 6% the following week. Your hand moves toward the sell button. You put the phone face down. You hold. Nobody sees that decision. Nobody applauds it. It is the most important financial move you have made in 3 years, and it happens in complete silence. The third rule: salary is a ceiling dressed up as a floor. The moment you see it clearly, you cannot unsee it. Level 4. $5,000 to $15,000 per month. At $5,000 a month, the architecture tilts. Not dramatically, not all at once, but the tilt is real and it compounds. You can contribute $23,000 to a 401 KEK this year and reduce your taxable income by $23,000. At the 22% federal bracket, that is $5,060 in taxes you do not pay this year. It grows tax deferred. Most people at this income level are not doing this at the maximum. The ones who are building net worth faster than the ones who are not, and the gap between them widens every year without either of them actively doing anything different. Your mortgage rate drops. A borrower at $7,000 a month with a 760 credit score is offered a rate that, over a 30-year loan on $350,000, saves $68,000 compared to the rate offered to someone at $2,500 a month income. Same house, same bank, different price. The bank is not being generous. It is pricing risk. The question the system never asks is who constructed the determination of risk in the first place. You wire $40,000 to your parents. You do it before telling anyone. You buy a 2-bedroom in a city where a 2-bedroom signals arrival. You tell yourself the hard part is behind you. You are not wrong. You are also not right. The fourth rule: the first milestone always arrives smaller than expected. Not because the number is wrong, because you moved while you were waiting for it. Level 5. $15,000 to $50,000 per month. Above $180,000 a year, income stops being the primary variable. The system pivots to assets, what you have accumulated, not what arrives each month. The two are related, but they are not the same, and the distinction determines what opens next. The effective tax rate becomes the central problem. Federal income above $578,125 is taxed at 37%. State taxes in high-income states add between 9.3% and 13.3% on top of that. On $600,000 in W-2 income, approximately $290,000 leaves before you make a single decision with it. This is the level at which income structure how you earn, not how much begins to matter as much as the number itself. Capital gains are taxed at 20%, carried interest at 20%. The knowledge required to restructure your income this way is not free. The people who have it are not sharing it on public platforms. Accredited investor status opens formally. Private equity, hedge fund allocations, real estate syndications, pre-IPO equity. These instruments have historically outperformed public markets over long periods. They also require minimum commitments of $100,000 to $500,000, multi-year lockup periods, and relationships that capital alone does not purchase. The accredited investor threshold was designed as consumer protection. It functions simultaneously as the mechanism that concentrates the best returning instruments among the people who need the extra return the least. You stop attending most events, not because you are too busy, because the conversations are no longer useful. You notice this and say nothing about it. The fifth rule: above a certain threshold, the game does not get easier, it gets quieter, and quieter is harder than it sounds. Level 6. $50,000 and above per month. Above $600,000 a year, income is no longer the conversation. The people at this level stopped optimizing for income years ago. They are optimizing for structure. The income at this level is often not income in the technical sense. It is capital gains, dividends, carried interest, distributions from trust vehicles. Each is taxed differently, most at 15% to 20%, rather than 37%. The system that taxes labor at 37% and capital at 20% was not designed by accident. It reflects a deliberate policy choice about which kind of economic activity the code was built to reward. Understanding that does not change the rules. It changes what you build inside them. The loan terms available here are not posted on any board. They are negotiated. A private banker presents a rate that reflects the totality of the relationship, the deposits, the assets under management, the long-term trajectory. On a $4 million mortgage, the difference between the published rate and the negotiated rate is not a rounding error. It is $80,000 to $120,000 over the life of the loan. The products that exist at this level do not appear on websites. A structured note tied to a specific equity index. A private credit facility at 3.1% against an illiquid asset. A co-investment in a fund closed to outside capital. These require capital to access and relationships that capital alone does not buy. The relationship at this level is the instrument. The sixth rule: you are not a client at this level. You are a relationship. A named line item in someone's performance review, worth more to the institution to keep than to lose, and structured accordingly. Somewhere in this city right now, someone is opening a banking app for the first time. Their income is $500 a month. They check the balance twice. The number does not change. They think the problem is the number. The problem is not the number. The problem is that the number is a signal the entire system reads before they say a word, before they walk through a door, before they apply for anything. Every level changes what the system offers you. What does not change is the mechanism. The system opens every morning. It does not ask what you know, it asks what you earn.